This video is about strategies that you use about how to get the lowest rate on your mortgage to save your money over long term. Now, right now, currently, as of today, which is 10/2/25 October, average mortgage rates are sitting around 6.3%, which most people think is high, but historically speaking is not that bad. But what we're gonna really focus on today is how, if you shop around, know the right things, you could save hundreds of dollars on your mortgage by working with the right lender, thus saving you money over the long term. You also learn about how different lenders price their loans, the products they offer, and why they offer those products at those prices. Let's start out with why mortgage rates move. Now, we'll start out with a bigger picture here. Mortgage rates don't just work out of thin air all by themselves. Mortgage rates actually move along with the overall economy. So most people are paying attention to inflation. And something that you'll learn about mortgages is the higher inflation is, the higher mortgage rates typically follow. Next, you're gonna look at the Fed and its interest rates. And how does this affect mortgage rates? Well, most people think when the Fed cuts their rates, mortgage rates follow. That is not true. In fact, after the most recent Fed cut, mortgage rates went up because the bond market didn't like it. Now, one of the biggest drivers of the mortgage market is the 10-year Treasury yield. Mortgage rates usually follow it quite closely. When the yield on these goes up, mortgage rates typically follow, which would mean when the yield's going down on the 10-year Treasury, mortgage rates are moving down. Next, we have what's called mortgage-backed securities. These are types of securities that are very attractive to investors. When investors buy large groups of mortgage-backed securities, it actually pushes rates lower. The same thing applies when the Fed itself buys a bunch of mortgage-backed securities in their program. That pushes down rates dramatically, which at the last Fed meeting, they said they were not doing, which is why we didn't get a lot of push down on mortgage rates. So let's talk about why people buy those bonds, the 10-year Treasury. Those things are bought because it's called a flight to safety. So the more volatile the environment is, the more things that are chaotic, the more money goes to the 10-year Treasury, which in turn pushes interest rates down. Next, if you look at mortgage-backed securities, and we talked about the government buying them, the more the government buys those in large blocks, the more it also pushes down, which enables interest rates to go down as well. So how do lenders figure out what interest rate they're gonna give you? Well, let's jump right in. First, they look at your FICO score. Your credit score is super important. Now, there have been some changes updated. It's called Vantage Score 4.0, which is not a cool Tesla. It's actually something that's gonna look at your rent history, your utility history, to give you more options that lenders can now offer possibly better rates because of this. But mainly, we're looking at your credit score first and foremost when we start looking at rates. Next, they're gonna look at what type of loan are you getting. Is it a conventional loan? Is it a high balance? Is it FHA? Is it VA, USDA, Jumbo? All these different programs all have different rates according to what's required in them. Next factor is loan term. Is it a 15-year fix, a 20-year fix, a 25, a 30-year fix, a 40-year fix? Every single loan has a different term and they're all priced independently. The shorter the term, the lower the rate. Pretty simple. Next is down payment. The larger the down payment, the better the interest rate you get on your loan. Now, sometimes there are smaller barriers where you can get a really good bump. Like example, let's say 10% down versus 9.5. Sometimes you get a big bump just by these subtle differences, but your lender really needs to know what they're doing. Next, if you're refinancing, the more equity you have in your house, the better the interest rate you will get. Even the property itself is going to come into play. Home loans are priced differently, from single family homes to condos to 2 units to PUDs to townhomes. Every single one of them is priced differently. So take that into consideration, and especially when you're shopping with your realtor, you really want to make sure the realtor knows what sort of property you're looking at, because sometimes properties look like homes, but they're actually condos, which have worse pricing on rates. And also, don't forget, each lender has their own business model, their own profit model, and their own margins. The easiest way to think about this is those who have the lowest amount of overhead are going to be able to give you the lowest rates. Banks, credit unions, retail lenders, anybody that has brick and mortar businesses, HR, everything in overhead, that is baked directly into your interest rate. So who typically has the lowest rates? That's mortgage brokers, because they have the lowest amount of overhead. We're gonna go into more detail about this, but typically shop around, with a couple different mortgage brokers because they're going to pretty much offer lower rates than banks, credit unions, retail lenders, all of those brick and mortar businesses. The smart way to shop interest rates, well, depends on who you talk to, because your realtor may tell you to talk to 4, 5, 6, 7, 8, 9 different people, or your friend may tell you to talk to 20 people. But the reality of it is, if you do your work correctly and you listen to about lenders that have low overhead, you can typically shop 3 to 4 lenders who are going to be able to give you top quality rates and good service, or you could just basically call me and win right away. Just a pro tip, before you start shopping lenders, make sure you fix your own financials. Make sure you have your own house in order. Make sure you have a general idea about what sort of loan you're looking for, your credit score, your down payment, and all the things that are important to you, so that you share that information with the lender to make sure they do give you the best product for your needs. Now, comparing lenders, what's an easy way to do this? Well, ask for a loan estimate. A loan estimate explains all the costs of you acquiring the loan. It will also have the APR on there. Here's a pro tip just to look at. The interest rate, whatever it is, let's say 6.25, the higher the APR, the more fees that are in there. So the closer you get the APR to your real rate, the better deal you're getting. Now, with that loan estimate, a majority of the loan estimate will have all third-party fees on it: title, escrow, property taxes, insurance. Some lenders are going to lie and give you fake stuff just to draw you in, and then later they will switch it all back to the normal. Because you have to remember, lenders don't control third-party fees. We only control our own fees. Again, the loan estimate is going to help you avoid this. Now, on the loan estimate, when you're going to look at lender fees, you're going to look at Section A, which is the top left-hand quarter. That's where the lender fees are all going to be listed. All the other fees are going to be all those third-party fees that we talked about. So most lenders will have processing, underwriting, and maybe a couple other small fees, but they all should be pretty similar unless the lender is gouging you. Now, when you're getting your loan and people start talking to you about buying points means you buy down the interest rate. And a misconception a lot of people have is if you pay 1 point, the interest rate goes down by 1%. That is not correct. That scale is completely different. The key way to think about points is look at your savings. If you're not breaking even with your savings by paying a certain number of points within 3 years, maybe you could reconsider doing that. If you remember the tip from before about making small differences in your down payment, these can unlock a lot of different pricing rates on your interest rates. So make sure your lender goes up with you. What is the difference of 10% down, 9.5%, 20%, 18%? All these different things are going to come into play. The reason why is your mortgage ultimately gets turned into a mortgage-backed security on the secondary market. And the appetite for those, which means people buying them, is different each day. So make sure your lender goes over with you the different options in the down payment amounts and how it affects the interest rate you're getting. And lastly, don't overlook special programs. Sometimes there are special programs that offer you amazing rates that only apply to certain areas, certain income groups, first-time home buyers. All of these are great things your lender should go over with you, because if you fit in that box of some of these programs, you can get an amazing deal. Let's take a look at a real world example here just so we can bring all this together. So as an example, let's say somebody with a 740 FICO is buying a house with 20% down payment, and they talk to a good lender, and the lender comes back and says, hey, your rate today is 6.25%. And then another buyer comes in with a 660 FICO score, buying a similar house, but with only 3.5% down, but their loan program is FHA. Now the interest rate could be down to 5.625, 5.75, because it's a whole different program. That's why it's so important that your lender goes over with you each different program and what rates they can offer with them to see what best fits your goals and needs. So don't always assume that just your conventional 30-year fix is the best loan for you. Make sure the lender takes time to go over options, because it's always better to explore everything. Now, there's two common misconceptions I see with a lot of people when they're shopping for mortgages. Number one, they shop around thinking that a lot of the fees will be negotiated and they can grind them out and get them lower. The reality of it is the lender fees are very small, but title, escrow, county recording fees, government recording fees, property taxes, insurance, all of these fees are non-negotiable, and they won't negotiate with you. So if some lender promises you that none of those fees will apply to them, they're lying. run the other way. The next myth is timing the market. Some people tell you they can time the market perfect, but even Warren Buffett tells you he can't time the market perfect. Just make sure your lender is paying attention to the trends following rates each day, because one thing's for sure, rates move up very fast and down very slow. So don't rely on timing the market. Just be consistent with talking to a good lender that keeps his eye on the rates in your situation for you. And for those of you out there who are wondering when rates will be lower, well, honestly, no one knows, but I will tell you, in 8 to 12 months from now, by the time the Fed cuts a couple different times and new economic policies come into play, it's very likely that rates will be lower in 8 to 12 months from now, and a lot of people will refinance, and we'll go into that more in depth about how the best way to save there as well. So we went over what goes into mortgage rates and how the economic environment moves them. We also went over how to build your credit, take better care of it, to know what goes into your interest rate. We also went over property types, what goes into your interest rate with there, and finally we went over down payment and loan types. And finally, the real meat of the whole video is whatever lender has the least amount of overhead will be able to give you the best interest rates. So my advice to you is talk to 3 different brokers, because they are going to have the lowest rates because they have the lowest overhead. That way you can get a really good deal on your interest rate. Thanks again for watching. Appreciate your time. Don't mind the bad comments below. Send them over.